quickly do a poll whilst our panel gets ready. So Jim and his panel is going to join. Charl Malan is online, so we will make sure he's all linked up. Can I ask you to quickly take up your Slido disc, your phones, click on the link, and I just want to kick off this conversation. And Jim, I've stolen 2 minutes out of my time with Rose, so I'm not stealing your time yet, I promise you. So if we can quickly go to the poll questions. Where's my code? Oh, there. I'm slow now. So, Jim, the question I'm putting to the audience is, what should investors be focusing on in Africa? Now, of course, you guys can say everything or yeah, but this is, as you know, just like a crude little check there in front of you, you can see. Responsible and sustainable mining practices, risk-appropriate returns based on realistic economic parameters. That's for the copper miners, obviously. Country-specific risk issues around policy changes. I mean, and do we really care whether it's a GNU or a ANC or a who knows what party running the place? So let's see where our audience goes with this. Or the 40-odd people who are either awake, have got a phone, or found a young person to help them with the poll. I'm not going to count, but there's more than 40 people online. So, okay. So I thought perhaps, Jim, without setting any tone, just to check in with the audience. The audience says investors should focus on responsible, sustainable mining. It is ultimately about decent returns appropriate for the risk. Over to you and your panel. Thank you.
Is Charles up on the screen yet?
Charl is online. Can we please link up with Charl?
That's great. Thank you. I think if you've been here over the last day and a half, I think that strikes you is that access to what are being redefined as quote-unquote critical minerals has become an issue of national security for really first time since, I suppose, the Second World War, and has become, in many ways, a symbol of was perceived as a contest between China and the US, and Africa kind of sits at the heart of part of that struggle. You then get questions arising over the Western mining industry's ability to compete and its ability to supply the materials that all the demand projections tell us are going to be needed. And a major question in all of that relates to the availability of funding. Firstly, for an industry that has been characterized by, at times, very poor capital allocation in the past, and also at a time we'll discuss over the next half an hour or so, when the whole investment industry itself has actually gone through a period of wholesale change. So with us we have three very experienced investment managers. To my right, Justin Baring of JB Management. To my far right, George Cheveley from 91, and on the screen, Charles Malan, who's the mining specialist at VanEck in New York, who sadly could not be with us here today. So let's kick off kind of like a high-level picture of insights into your investment philosophy. Actually, what makes you think? What are you looking for in a compelling investment idea? So Justin, why don't I start with you?
So we run a long-only gold and general natural resources fund. We sort of look at our investments through the prism of what you pay to relative to what you get. And I think that probably is the Bernard Swanepoel way of looking at things. Keep it very simple. What is the market capitalization per ounce, ton, kilo, pound that you have to pay to buy a listed company? And what is the profit per ounce after tax that you will get back from that investment? So that's the prism that we look at everything from. The pricing, of course, is of vital importance as to what you get back from that. And what we do is we look at the capital cycle as a way to try and gauge the future prices. The capital cycle is any business that has high returns on capital will generally have competition for those high returns, and so therefore the returns will sink over time as those returns are competed out. When the prices are low, capital withdraws from that business metal, and so the future returns are probably going to be higher in the future than they have been in the past. So the capital cycle is a very important the way in which we sort of analyze metals that we invest in. Clearly, the possibility of political risk changing, where the discount rate is somewhat punitive at one stage, but less punitive at another, or vice versa. That's a key criteria for us to try and make sure that what we're actually going to get back is higher than what we pay for the assets. And then the cream on top is obviously if the company is able to discover new ounces or pounds or tons that weren't already impacted into or reflected into the market value. But that's the overview of what we look
To
for.
say, as a former investment manager, the idea of actually getting more back than what you paid for it was a great concept, which occasionally actually worked out in practice. George, if you could address that, and also, is geography important or not?
Yeah, so on the first point, clearly we're looking for value, and we're looking for companies that can grow value. And where we're looking is where we have a different idea of value to the market. So we obviously think there's more value than the market does. Quite often though, and actually it was mentioned, I think it was Dominic Barton this morning, and I thought it was a key point, where everybody focuses on value, but not how do you get there and who are the people who are going to do it. And that actually, when I think about it, it's one of the key things you look at. It's not just, is the company, do we think there's value there, but do we think there's a management team? And what are the catalysts? What is the management team going to do to realize that value? And that's actually a key part of the investment decision. In terms of geography, yeah, geography matters, but it's diversity. We want a spread of geographies. So, we're constantly asked by clients, what's your split? And they're always asking by split by listing. And I'm constantly saying, I don't really care where the company's listed. I care where their assets are. And one of our key, risk parameters is just making sure we're not concentrated in any one area. And that might be Mali, Burkina Faso, or might equally be Australia, particularly Queensland, who are probably the worst for changing royalties of any state in the world.
We'll get on to that one. Just staying on this theme, one of the issues now that you face within institutions is, how do you attract a generalist investor into a mining stock? George?
Well, you have to show them you can deliver value and deliver returns. And I think, and it's hard. and the funny thing is, I still meet people today who say, oh, mining, it's been terrible. And I go, look at the last 5 years. Total returns out of mining have been better than most sectors. I think one of the problems, weirdly, is they look at share price charts and say they've done nothing, and you then point out, well, they've been, particularly, UK, Australian companies, they've been chucking them double-digit dividends every year. So you take a total return, and it's much, much more positive. I think Rio, actually, I was looking, I think on share prices 0 over 5 years, total returns 50%, because you've had, those dividends. So one is pointing out there are good returns to be made, and I think sometimes it's always, mining's terrible. It does make money. I do think the second problem is there is this revert to mean the whole time, and persuading people. So, I was talking to a sell-side analyst. He said, the trouble is we go in to see these generalists and we say, got this great company doing really well. And he said, here we are sitting at, let's say, gold company, 3,300. And the long-term price in 10 years is 2,200. So you've got to buy this company. It's really good. Its earnings are going to decline every year for the next 10 years. And that is an issue we have to get over, is like this sort of, what prices are you using and how are you developing that in the company?
Indeed. Let's move on to a slightly different topic and bring Charles into the equation. Charles, how has the investment landscape changed in your view mean, the one statistic that sticks in my mind is that if you look back to the China boom, mining was 5 to 6% global equity markets. For the last 10 years, in other words, it's not a temporary phenomenon, it has averaged 1.8%, i.e. sub 2%, which in the investment management world is a fairly crucial number.
Can you not see the screen here?
Charles, over to you.
Oh, it's me? Sure. A great question, and I guess the question that you asked before is how do we make the mining industry a relevant industry, sort of feeds into this, and that, as you said, we've gone from 5% to 2%. We were, and I think in the 1980s, we were somewhere around 11% of global equities. Just to put in context what 1% is, Apple at the moment is a 2.5% equity of global equity. So clearly, as an industry, we don't really feature anywhere. I mean, you've got to put in a little bit more context to that, maybe, is if you think of Apple announced a share repurchase program earlier this year, late last year, of $100 billion. So put that $100 billion up against the market cap of this mining industry, and then you really start understanding how big the world is that we are competing in and how we actually make ourselves relevant. And so if you think of how the investment landscape has changed, as relevancy is important as an industry. And I sort of want to echo what Justin and George said about relevancy is we need to, what I call stand and deliver, right? There's been for too long a time frame, there's been issues within the industry where management made promises of certain value creation goals or various strategies or tangible catalysts, and they were not able to deliver that. And outside of maybe the specialist funds like the three of us here, a lot of the generalists have just decided that they're not interested. I mean, some of our clients, to put that in further into context, our clients on average, the big institutional insurance companies have maybe 2% of their assets in the mining industry. And over the last number of years, that has been more of a problem child, to use that term. And so for the asset allocator, they've decided, why should we even put 2% into the mining industry, considering it's a problem child for itself? But to go back to the point is, the industry's got to stand and deliver. Deliver on what you promise you're going to deliver, right? That's how we all get measured. Create value, return capital. That's the key thing. The second thing is just the entire perception of this industry is industry that we destroy stuff. That still, although I know the ICMM and many other organizations have done a lot of work on this, we need to continue to work harder on the fact that our perception is not a positive perception. And the last thing is, which I do believe the ICMM has done a really good job, is we need to start controlling the narrative around this industry, specifically brand management. Start showing them actually how critical are we for Apple, how critical are we for electric vehicles, how critical we are for various other decarbonization entities. And then the last thing, maybe we need a big large-scale consolidation in the industry, right? Go back to Apple doing $100 billion share buyback. Maybe we need to get into an industry that can do these types of things and be much bigger. But I'll leave it there. Thanks.
Yeah, thanks, Charles. We will get on to the consolidation issue later, because it has been one of the elephants in the room for a few people. One of the big changes, and Charles, I'll let you address this first, has been the rise of passive equity funds. And just to give you two statistics, passive funds now account for over 50% of assets in US mutual funds. In the last 18 months, they've gone past that inflection point. Vanguard alone, which is one of the largest passive fund managers in the US, the last statistic I looked at, they were close to 30% of US mutual fund assets. Now, I have to say, having grown up inside like George and Justin, inside an organization where it was just purely long-only active management, I find it difficult to think about how does a company discuss capital allocation with the shareholder base when there's no real shareholder to talk to. Charles, I'll let you tackle that one first.
Sure. So thanks. Maybe I should just go back and introduce myself quickly, because VanEck is known for a big passive index manager. So As Jim said, I'm Charl, and I work and live in New York. I've been with VanEck for 23 years. I work on the active management side. So as Bernard might remember, going back 2 decades or so, we were one of the biggest US-based natural resources, precious metals funds. We were also one of the first ones to launch passive indices within this industry. So I've seen this firsthand, to your question, Jim, excuse me, I've seen this firsthand how that has completely changed. And I think the point with passive management, I mean, at the moment, the flow of capital is incredible. We had last year $1.2 trillion flow into ETFs. That's twice the size of 23, twice the size of 22. And we had $166 billion flowing out of active management. So the industry is changing significantly. And as management, you have to adjust to this. There's one other type of product in the United States that's taking off quite aggressively, and this is what we call model delivery. So really what a model delivery product is, and this is going to make everybody's job even more complicated than it is already with ETFs. Effectively, I make up a model of companies that I want to invest in. I deliver that to my client, my institutional client, my insurance company. And then they have the ability to execute upon that. So they take the entire back office, the trading, the reconciliation out of my arms, and they start doing that themselves. The reason why that is so popular is because there's a much better tax efficient strategy for them in that. So ETFs is one thing where we are removing the management away from the shareholders. Model delivery is the next thing. Last year, model delivery adoption grew by 25%. So watch out for this in the next 3 to 4 years to grow. But that's not the question. The question is, what do we need to do as management, right? The key thing here is you need to know who's your shareholder. So I think if you don't know how do you end up in a index, I think that's critically important to understand what makes up the index. So how do you end up in the index? Every index has a manager, or whomever manages a ETF according to that index has a manager. I think it's critically important you know exactly who that person is. Now, the point is that that person's not going to listen to you because you're going to talk about strategy and your value. But when there's big issues, big events, whether it's a proxy, an M&A, or things like that, you need to know who to call and who to speak to. I think it's also going to be critically important that we focus on diversifying your shareholder base outside of just the traditional managers. I mean, there's funding out of Saudi Arabia, the DOD, the DOJ, the DOE and the DOD is looking for funding at the moment. So maybe we should looking at them. The World Bank is looking for funding. I think the point I'm trying to make is traditional funding sources, as we know, are changing dramatically. Your investment relationship team is going to have to look at this much more creatively, and they're going to have to get much closer to your underlying actual shareholder. You're going to have to make it easier for them to access you, so you're going to have to be available to them to speak to, because again, they vote and make decisions based on parameters that's not necessarily associated directly to value creation and the ability to manage a company. Thanks, Jim.
Charles, thanks. George, do you want to pick up on that issue, the passive versus active?
Yeah, I think it's an interesting one. I mean, I sometimes like to think the rise of passive is sort of helpful in the sense it will eat itself. It also, though, it puts pressure on us as active managers to be properly active, which is good in a way. We can't just be index huggers because we'll be, there's an alternative there. So I think in a way, as an active person, it makes you more active, which is good. I think Charles' point on the technical side, when it comes to major votes, you need to know who you're talking to. I think is a very, very good point, actually. And I think that's one certainly some companies should be listening to. I also, though, I think sometimes I found it odd when I left industry and came onto the buy side.
For those who don't know, George actually did have a real job.
So I was at BHP before I joined 91, a long time ago. I had more access to the CEO of BHP when I was on the buy side than I ever had in the company. And I say to companies constantly, which obviously is oxymoronic, I said, just don't listen to shareholders. And what I mean is, you know more about your industry, you know more about your projects. So when companies come and say, do you think we should do this, or should we pay a dividend, and whatever, I'm like, do the maths, work it out, make a case, explain what you're doing, and if it makes sense, that's great. And I think sometimes, you yeah, I think companies need to have the confidence to say, this is what we're doing, this is what makes sense, we can show you the numbers, and we're getting on with it. And plenty of companies do that, you know, and I think that's a good thing. So the sort of worry, there's more passive shareholders, who do we talk to? Well, talk to the same people, but make your mind up before you talk to them.
Okay, thank you.
Jim, just on, I mean, I think one thing that people forget about is that we are in a cyclical industry. And if you're allocating capital to the largest, and that's the basis of how you're going to invest, in a cyclical industry, what's the largest at one time of the cycle is often going to be the worst time to be investing in the largest. And I think passive investing compared to active in a cyclical industry, we as active managers have got a real opportunity to show that being contrarian, trying to work on the basis that you're paying less than you're going to get back, you'll do that if you remember that you're in a cyclical industry.
Well, let's stay on that topic of cyclicality, and let's move on to talking about which commodities you potentially see as being greatest interest. And I've picked out three which are of particular relevance to Africa, which is gold, copper, and PGMs. So Justin, if you want to kick off on gold, long-suffering shareholders finally seeing some returns.
Yeah, I mean, gold, the big debate that we're having is trying to persuade investors to buy gold shares rather than gold itself. You know, there's lots of money that's gone into the physical, and we make the argument that you can buy gold much cheaper in the ground, unmined, then pay the cost to mine it, and then get a dividend and growth that your block of gold will not get. So I still think that it's very compelling that the gold miners are a cheap way of owning gold. Now, gold's gone up a lot. Gold is very fashionable. I get lots of people telling me how good it is that they own a bit of gold, which 2 years ago, it was sort of like a swear word. Now people are more enthusiastic about it. But I think that the higher gold price is a game changer for the companies, and they could really have a chance to show that they are better investments than the physical itself. And I think on the platinum group metals, this capital cycle prognosis is absolutely perfect. We can absolutely know full well that no one wanted to build a new platinum mine because they're electric cars, and then the internal combustion engine is going to die forever. And there's been a dearth of any investment. I think that Platreef, they first put money into the Platreef 16, 17 years ago. These things take a hell of a long to adjust to a pricing change. So I think that the capital cycle is absolutely perfect for the platinum group metals.
Charles, you missed yesterday a very bullish presentation on PGMs from Craig Miller from Valterra. Of course, you would not expected him to do anything but that.
Had to.
But would you share Justin's optimism?
I share the optimism in a number of ways, right? So whether we talk gold or PGMs or copper, but I guess gold is the best example at the moment because you've had a real strong rally in the commodity price, right? I think it's important here, and this sort of goes back to how do we make this industry relevant, right? Is you've had at least the industry is expecting, the investors are expecting you that you've had a massive margin expansion, hence massive free cash flows being generated because the gold price has moved so much. When we get commodity movements like this, and platinum seems to be at least going in that same direction, not to the same extent, but the same direction, right? I think it's important that the company starts showing us that capital is actually truly coming back to shareholders. I think that's the thing that I'll take out of Justin's comment that he made about that. I think the other thing that makes this interesting is the whole passive versus active side of it. So platinum all of a sudden is becoming really interesting, you know, as you know, and as Craig said yesterday, there's a lot of supply and demand fundamentals that's moving. But platinum as a commodity and platinum as companies or equities is actually that place where we as active fund managers can actually make a real difference relative to the passive indices. And as an investor, like George says, that's the companies we really want to get into. As long as the management delivers on their promises, right, that's where we get really excited. So we get excited about platinum. Commodity price seems to be moving for supply-demand issues, whether it's rain or other operational issues that's around where the inventories are falling down. But what we're getting excited, and what Craig sort of started talking about yesterday, I assume this is what he talked about yesterday because I saw him a couple of months ago, is how he is going to start focusing more on what I'm going to generally call value over volume, start reducing the company's sheer size and make it more profitable. That's the stuff we get excited about, and we want to see that being delivered. But I'll leave it there. Thanks, Jim.
Thanks. George, one commodity you've had a lot of experience in is copper. And that is one commodity that does seem to sort of stand out from the pack in terms of the structural characteristics around the industry.
Yeah, I mean, and it has done for a long time. I mean, copper's always been, going back 20, 30 years, you would do long-term studies, and copper always stood out as one that, it's been around a long time, it's got a huge number of uses, it's difficult to mine, rent tends to go to the miners. It's always a commodity I think you want to be in long-term. Obviously then, that sounds great, and then you do the numbers, and actually, who's made money in copper, it's not so obvious sometimes, and certainly a lot of capital has been wasted at times on copper. But yeah, I think it's hard to argue against it today when you look at, as we're talking about energy transition, electrifying the world, this will come. I do think, some people talk about that and say, right, copper's going to the moon. No, it will get substituted. People are price sensitive. It's also true that there hasn't been no investment in copper. There's been plenty of new mines come on as well, over the last few years. So, but it will be still a good commodity to be in. We will see returns. And it's really, I mean, if you look at, companies like Antofagasta who've just continually invested through the cycle, they can actually make decent returns over time. And if you believe that, I sometimes think people get too concerned about the cycle. Something in copper, if structurally you think that's a good commodity, will be required. You just, if your project is not the highest cost, you need to get on and start building it. And I think you do see some of these companies have pulled back, underinvested, then overinvested. And a consistent approach when you've decided that's a good commodity is really the proper way of doing it.
We'll come on to the investment side of it maybe in a few minutes, but maybe if we move on to talk about perspectives on Africa with the caveat that it's hard to generalize about a place which after all is, I think, about 125 times the size of the UK. But what is the relevance of Africa in an investment context, Justin?
I mean, emerging markets, I think, represented 8% of the MSCI world 10 years ago. It's now down to 6%. So Africa within that is contracting because the dominance of technology companies. So frankly, I think Africa on the investment landscape is nothing, is nowhere. That doesn't mean there's not great opportunities there. The ability to work with partners in a country where they're desperate for investment, they're desperate for all the good things that come from mining, and I completely agree with every single mining company I've ever gone and visited. The flow-on effects of all the good work that they've done is just so easy to see. But very often they're desperate for investment, and they're accommodative to working with you to get a return from that investment. Now, the cycle changes and the politicians change, and then suddenly they get aggressive against the money that they were so courting in a previous cycle. And that's my point about the political risk, is that it's very cyclical, and politicians have short memories, they have short spans of terms, and they make short-term decisions. But I think that investors, again, thinking contrarianly, thinking long-term, can say, well, at one point in the political cycle, this is worth very little, but in another political cycle, it's worth, it's going to be worth a lot more. I mean, Mali was the darling of everyone 10 years ago. It's now hated by everyone. These things change and they're cyclical.
Yeah, let's pick up on that, because Africa, it's constantly evolving and changing. And as you say, West Africa was the focus for a lot of people some years ago. George, in your view, is just parts of West Africa now just uninvestable?
You have to look at it by country. I'm not pouring money into Mali at the moment, and I'd be wary of Burkina Faso right now, and Sudan, of course. But I agree with Justin that there are cycles, and you get governments come through, but they're not always, not always returning to the same point, and things do change. I mean, people talk a lot about Chile and the transformation since the 70s today, and what's happened in that country, and in a number of other countries. So there are improvements, possibly people will say, of course it isn't, but people say, Argentina could be on the same change. So, in Africa, we've seen Tanzania completely change. Côte d'Ivoire was untouchable 12 years ago, whenever it was. Now is the new darling in some cases, particularly in gold. Guinea is emerging, I would say, with fits and starts, but coming through. So you get, depending where you are in Africa, it changes all the time, and not every country goes back to where it was. Some break through and, improve, some return, it really depending. Again, as an investor, I don't think you can ignore it. These are very rich resource countries, but you have to have, I would say as a fund manager, that's what we provide you, diversification. So you might be able to take these returns, but we're active. We can adjust as these things change, and that's why you need to be active. But I do think the sort of nothing's going to change, it just cycles up and down is not true. They do change structurally as well.
I mean, the one area that has probably been off a lot of investors' lists for a long time has been South Africa. It struck me at the Indaba this year in Cape Town, for not one of your conferences, but shouldn't be referring to it, that it struck me the first time in years that there was a sign of a less negative or almost bordering on starting to be positive mood around South Africa. Charles, would you agree that there's signs of change or progress in South Africa, or are you not holding your breath?
Well, no, I definitely think there's change in South Africa. I mean, I'll share that with you, is that for the better part of the last 15 years or so, we had close to zero direct exposure to South Africa through the mining industry. And we know there's lots of gold and there's lots of platinum companies there. And we are fortunate that we are not restricted by geographical region. We totally focus on return on capital as a metrics for our investments, right? But then with that, over the last 5 years or so, 3 years maybe, there's been a couple of positive trends within South Africa. And actually now we are back in some of the South African gold names and back in some of the South African platinum names. So South Africa is looking much better. Now, the approach to South Africa was not a blanket approach to the rest of Africa, right? So sort of what George says about West Africa, it has to go country by country, but clearly that geographical region of Africa is the more of a concerning area for me within Africa than what something like South Africa is at the moment.
Okay. Let's move on to the...
I'll just add one thing on that, because I worked for, obviously in 91, has a big office in Cape Town, and I've been there 18 years, always in London. Over the years, I've seen a sort of trend of people wanting to move up to London, and then a few years later, people moving back to Cape Town. And definitely the last 2 years, the flow in our office has probably been more back to South Africa than up to London. So I can always tell how South Africa's doing by the number of people moving.
That may equally be just as much a reflection on the UK.
Well, true. Or it's relative, maybe.
Or just the bankers.
So
One thing that gives me, is amusing
Very
to
quick.
me is that Harmony Gold Mining and Pan-African Gold are by far the best gold performance share prices over a 5-year period. 5 years ago, you said to anyone, would you ever invest in either of those two? And they say, no way. And it just is, the irony of that is great.
we'll not get too much into Harmony, given who's sitting to my left here. Industry consolidation has been talked about. This is an industry with few companies over $50 billion market cap. And if you look at the structure of a lot of the major world indices, a lot of mining companies just struggle to get on the radar screen. George, is consolidation a necessary part of the answer here?
I'm coming to the conclusion it is, and from both sides. One, we've discussed the sort of size of mining companies and indices. Not the overall, but just the sheer scale, and the large generous investors just going, I can't, there's less companies I can invest in, they're too small. So from that side, but actually what struck me more recently is you talk to the large mining companies, they talk about their growth projects, copper particularly, they all want more copper. And they talk about these projects, and it's now minimum 5 for an expansion, and we're 10 plus and 10 years plus for a new mine, 10 billion or so. And you actually look at the number of companies who could take on that risk by themselves, and BHP and Rio possibly, and then you run out. And so either there's got to be, and there are JVs, the oil industry did it, there's more JVs and stuff, but you sort of say, look, surely we have to have some larger companies here to deal with these risks of these huge projects that are required. And so I think both, there's investors who say we want large companies. I think from managing the risks, both size of projects and geographical diversity, we actually need bigger mining companies.
Charles, would you agree with George?
I mean, I 100% agree, right? So, like, again, you think about the Apple share buyback, $100 billion, right? I mean, that's the numbers we as foreign or as US fund managers are dealing with. So how do you compete against that sort of share purchase program if you're majority of the industry, the top 5 is not even $100 million, right? The other issue that I think is important here that George sort of touched on is, and why consolidation is important. I mean, I know how many companies do I know of where the market cap is X, but the capital request to build a project is 10X their market cap. I mean, that's just not happening. I mean, I'm a specialist investor. I am not going to invest in you if you're asking me 10X your market cap. And in addition to that, by the way, it's another 10 years out from where we are now. I think it's something that we have to start really think about building a very big, large cap industry and then bulking up the mid-cap space without a question, yes. Thanks, John.
So I'm being told we have 33 seconds left. So I'm going to ask each of you for just one final quick comment. Justin.
I think that just on that point about allowing the businesses to thrive, doing deals that don't require big premiums, I think is very important. I think the last thing in the gold industry we need is a lot of money being torched on projects that are being done or in the future that should be done by serious mining companies that are getting bid up premiums because the market's hot. That's what
In other words, don't blow your brains out.
Don't blow your brains out, yeah.
Charles?
So I like to play on the word ROCK and the word ROCE. So on the rock and rock as in rocks in the ground. So mine is you can master the rock, right? So rocks, digging out rocks. But without ROCE, you're just digging holes in the ground. So I think it's important that executives start thinking about return of capital and equity versus just plainly simply about digging holes in the ground and getting rocks out of the ground.
Thanks. George, you get the final word.
I think as we're talking about Africa, I think all mining companies need to, particularly large ones, and they haven't all, need to have a strategy around how they develop resources mines within Africa and need to be thinking about it because clearly there's a lot of good geology there. And that needs to be part of their strategy.
Thank you.
I'm going to mess up such a powerful conclusion with questions. But I'll start with Jim first. And I've previously said sometimes we ask the real expert to chair a panel and then we lose the expertise. This question is addressed to you, Jim.
It's very flattering.
Well, I'm trying to be nice to you, eh? I mean,
Makes a change.
don't take it as a new me, eh? So, Jim, can you comment on the role of sovereign wealth funds, especially in the Middle East, on critical mineral development and investment in Africa? And I'm very keen for the question. I'm very keen to put it to you because you've had some thinking and some involvement in that.
Direct experience. Well, look, I think if you kind of step back and look at the whole source of funding for the industry, it gets back to what we were talking about earlier. Two other things we didn't really talk about. One has been the demise of a lot of the specialist funds. which they were the route to money for a lot of the smaller cap companies, and that there's almost now got, if you're $300, $400, $500 million market cap, you're almost living in a black hole in space in terms of access to traditional equity funding. That's point one. And point two, I would go to where we started out at, is that the first time ever I can remember, access to raw materials has become an issue of national security and is on the agenda of governments worldwide. And that, in part, starts to explain the involvement of some of the sovereign wealth funds. The one which I'm involved with is Manara Minerals in Saudi Arabia. There's another dimension to that as well, is that these countries are thinking of life beyond oil, and they've got a young, growing, educated population. Saudi Arabia has identified mining and mineral processing as one of the real growth poles for the economy in the future. And what they're trying to do with Manara is replicate in many ways what the Japanese trading houses did in the 1960s, 70s, and 80s. Take minority, passive, non-controlling stakes, well, the one condition being there has to be an offtake arrangement.
No, thank you. And we've discussed this before. That's why I was glad the question came and addressed to you. George, you messed up last year's London Indaba by saying, you know, I'm going to tell you how you messed it up. You said that the world needs no more exploration. I think. You were on the panel. But can I put you, so this is not about exploration, but do we need to allocate capital to exploration in bigger numbers, seeing that it's 20 years out, or are you comfortable that for the foreseeable future there's enough?
I'll pick up on that too after he's spoken.
Yeah. Do you remember you said that?
No, I don't. But anyway,
but I'm sure I'll play the video.
I'm that sort of age now that I don't remember everything. But I do. We don't invest in explorers per se, because they tend to be a bit small and they keep coming asking for money. So I like people exploring who are already producing some cash flow and can afford to pay for exploration. So no, we need exploration definitely. I think there's a lot of interesting tech coming through in exploration, not necessarily new drills, but how you analyze that data, and AI, should I dare say it. And I think, you know, we can all roll our eyes, and there's some examples, but I think there's some real promise there about refining, you know, data you're getting and how you can do that. So, no, we have to explore, of course, but I think clearly we need to find more. And people need to, you know, do it. I think it's right. Not everybody has to do it, but you do need exploration. But I'm not, in my role, I'm not going to be funding pure exploration companies. It's not my area.
And I'm sure the association was with your panel, not you, but it's nice to put you on the spot anyway.
No, it's fine.
Jim, you want to comment on exploration?
I'm going to kind of just, again, step back and look at this. I think about the mining industry that there's kind of four elements to how mining businesses work. First element is resource discovery, which is exploration. The second element is resource exploitation, which is mining and logistics. The third element is resource pricing. It's all about marketing, market structure. And the fourth element is basically about how you allocate the resources. You go from stuff in the ground through to cash flow. And the fourth element is how you allocate that cash flow. If you go back to the long China boom, what really happened is that a lot of the industry was solely focused on that third element, which was resource pricing. That's what drove BHP, Glencore, and Vale. They completely tore up the rulebook on the pricing of bulk commodities. During that time, elements number 1 and number 2 got completely ignored and forgotten about. That was the period when industry productivity went to hell in a handbasket. And then we got to 2012, 2013, and they completely screwed up element 4, which was the resource allocation. So I think the industry now is sitting back and thinking, A, we've got no projects in the pipeline. We really need to start rebuilding our exploration capability if we're going to, you know, go back to performing like what I would call the traditional mining company.
Good point. Charl, Yo, Bliksem, if I knew you were not going to be in London, you would have bought Tracy and I a steak in New York last week, eh? But you kept that secret from me. I know it's a known fact that you haven't invested in South Africa since I left 17 years ago, so we established that correlation. But you can invest in Harmony today, I promise you. Good CEO. If you see South African companies, are you seeing the smaller ones? Are you open to the Pan-Africans, or are you more comfortable rethinking about South Africa through Valterra and Harmony? Just give us a sense.
Yeah.
You're a big company and a big fund. How low do you go? How deep do you go?
How low do I go? That sounds like a dance I'm about to do, right?
Ons het nie 'n
just to-
vertalingsdiens hierson nie, so let's keep it in English. Huh?
I think the best way to put this in context, there's really two main funds that I'm involved in. The one is what I call the Global Resources Fund. And really in that one, we focus on, sort of similar to George and them, is we're looking for cash flow, right? We do exploration, but it's like chicken teeth is how infrequently to do it, right? In the gold fund, or the precious metals fund, I should rather say, we go all the way down market cap. And I would say about 30% is a round number, is most probably what we go into, as low as exploration companies. And so Harmony and Pan-African Resources will actually not fall into that category, actually would fall in the mid-cap category. So yes, we go all the way up and down the economic cap of the companies. Just depends with really what industry. And the reason why is the one fund is just significantly bigger than the other fund, and it's a liquidity question. I'll answer at the end of the day.
Thanks. And really, thank you for joining. We will get you in person. We've tried for many years, so we'll keep on trying. Justin, my absolute final question has to be to you. I'm not sure, you must have been in primary school when your dad was looking at the South African mining industry and saw structural problems. And he was an activist, fund manager, disturbing the South African mining industry. If we look at the mining industry today, do you see such structural problems, like serious misallocation of capital? Is a copper in, what is the big thing? Because obviously in the South African context, that intervention was big. Now, historical, what do you see, the next generation of structural problems?
From yesterday's presentations with the governments, I go to Kalgoorlie and see the activity there. Go to Canada and see all the exploration companies going to development companies. The hindrance to getting those sorts of things done in South Africa has just been such a missed opportunity. And I think that just following a model that's been so easily replicated in those two countries could be followed. I mean, South Africa's got a great advantage, and it's got a lovely savings pool that will allocate to good projects if there are lots of others that have led the way. And as I say, something like Pan-African has led the way and made investors money, so they'll look for the next thing. This whole beneficiation stuff is ridiculous in the context of just get that first thing right, and then you'll get the industry thriving and jobs and all the good things that come from doing what is just being done in these other countries, but hasn't been done because they're busy sort of tweaking the pie as it stands at the moment.
Ladies and gentlemen, it's lunchtime. We've run out of time. Thank you very much, Jim, and your panel. Charl, thank you very much.
Thank you. There you go.